Good morning, everyone, and welcome right across Africa to all our listeners. It's my great pleasure to welcome you all to this information sharing webinar where we will be discussing international property as a wealth preservation strategy. As you're all too aware, the world is currently facing a lot of economic uncertainties, which makes wealth preservation challenging. Therefore, it is of utter importance that all our clients and all our listeners out there educate themselves as much as possible, introduce themselves to as many alternative strategies that can help safeguard their own personal financial planning in the future. Investing in international property is exactly one such a strategy. It can help you to achieve your long-term financial goals. At Carrick Wealth, designing international wealth preservation strategies is at the very core of what we do for our high net worth individual clients all across our beautiful continent. Now, traditionally, we would be talking about traditional financial products. But we've organized today's webinar specifically to share with you our knowledge and our experience of how property can fulfill a unique role. My name is Fred van Niekerk, and in my capacity as General Manager for Carrick International, I've got the honor of being your host today. And I'm here to host a discussion and facilitate the conversation between our two esteemed guests, who I'd like to introduce right now. First, we have Mr. Craig Featherby, founder and CEO of Carrick Wealth. Craig has been in the international wealth advisory arena for more than 2 decades, and most recently has been voted one of the world's top 100 most influential individuals in this arena. Craig, welcome. Lovely to have you here.
Yes, good morning, Fred. Thanks very much for the invitation. It's a pleasure.
And then, of course, we've got Mr. George Radford. George is the Managing Director for RPA for the United Kingdom and Africa. George and I have been working together for more than 8 years, and RPA Group are one of our approved providers of investment-grade properties that we include in our clients' wealth strategies across Africa. Welcome, George. Thanks for being here.
Morning, Fred. Thank you very much. Good morning, everyone.
Great. Sounds working. Fantastic. Right. So without further ado, our listeners have given us very kindly an hour of their time. Craig, I'm going to revert the first question to yourself. A lot of our listeners out there might be intrigued by the fact that a traditional wealth advisory firm like Carrick, who normally ply our trade with traditional tools, if you'd like pensions and trusts and offshore companies and savings plans, and yet since 2015, we've wholeheartedly embraced investment-grade property as part of our clients' wealth strategies. Can you give us some insight as to why this has become so important for us as a company?
Absolutely, Fred. It was actually last night I was asked by a colleague of mine. He met someone in Camps Bay in South Africa and said, is Carrick turning into or converting into a property company? Well, actually not. We're a macro wealth management firm that uses all 6 asset classes, and property is a very, very significant portion of the tools that we have to try and preserve our clients' wealth. And as the slide says, wealth preservation involves managing your assets in such a way to ensure that the value of your assets do not decrease or erode. Wealth preservation objectives, the notion of maintaining existing wealth is far, far more important than making more money. But Fred, from a property perspective, investing in UK property has long been seen not only as a rite of passage, but as a true example of success for potential investors from around the world. It's attracted global interest for decades because it's offered income, an easy way to grow your wealth, and of course, stability. And I think you touched on it at the moment. Stability is obviously extremely important. During the past couple of decades, Fred, the market has been strong. As a result, even inexperienced or armchair-based investors have been able to achieve double-digit returns. But it's getting a little bit more trickier. The goal of preserving and sustainably growing your wealth has been seen by many as not exciting enough to draw their attention, or it has been seen as a strategy for later on in life, or relevant only to investors who've already made their money, the super rich. Well, as we're going to see later on in today's presentation, it's not the case anymore. Property investment, certainly in the UK, is strong, it's stable, it should form part of an investor's portfolio, and it's available not only to the super rich, it's actually available to people like yourself and I, Fred. So UK property from a Carrick perspective, what's important to us? Safe and secure. It's a safe and secure method to preserve wealth in such turbulent times. And our objective at Carrick is wealth preservation should be a priority for a large portion of our clients' portfolios. It's hard currency, of course. It's a hedge against the markets, hedge against currencies. Political insecurity is a mass across Africa. So we really try and build our clients' portfolio carefully and carefully crafted in such a manner that a large portion of their wealth is preserved for future generations. So UK property in general is a significant portion and a tool that we use, Fred, to help our clients really preserve their wealth for future generations.
Thanks for that, Craig. And yeah, I've certainly seen that in practice. You put the theory out beautifully there, and I've seen that in practice in our clients' portfolios over the years. It can be a wonderful, safe bet, if you'd like, during turbulent times. So a fantastic, certainly from my side, a very refreshing approach from Carrick to include property on that basis. But we're talking to our African audience, and we get to travel across Africa a lot, George and Craig. We get to speak to our clients in Lilongwe, in Lagos, in Lusaka. We get to speak to our clients across Kenya and Uganda. And in general, even though all of us have worked and lived overseas for a long time, whether it's in Europe or the Far East, I think we've all commented before that Africans and African businessmen are in love with property already. So the idea of property as some type of wealth strategy isn't new to most of the people we speak to today. However, what we do find is a bit of questions as to wait a minute, right? So I've done well, for argument's sake, with a block of flats in Lagos, yeah, or you know what, my property outside Nairobi has doubled in value over the last 5 years. So the property market in Africa feels vibrant. Why is Carrick then ignoring African property, if you'd like, for our clients, and then purely focusing on European, but mainly United Kingdom property?
I think it's very clear, Fred. We spoke about wealth preservation opposed to wealth growth or growing your wealth. African property is a fantastic tool to grow your wealth. I've sat with countless of clients, last of which was a client in Uganda. He said to me, my local property portfolio is growing at 22%. That's fantastic. Yeah, it's a great growth strategy. We're talking about wealth preservation. And wealth preservation, as I said, it's the idea of maintaining your existing wealth is more important than growing. And then if we start thinking about other factors that are extremely important as an African-based investor, well, there are three. first of all, let's talk about the currency stability of the UK, or converse of that, the currency instability of African countries. And if you have a look at the next slide, Fred, this is something that I put together a week ago, just taking some random African countries, what the dollar to the African country currency in 1992 was, where it is obviously today, and what's been the aggregate average loss over this 20 period. And then what I've done is I've extrapolated from 2022 for a further 30 years. And, you know, let's have a look at South Africa, my country. You know, R2.89 in 1992 bought you $1. Well, I'm afraid it's now 18 Rand and 17 cents will buy you $1. That's been a depreciation of 6.32% over that period of time. And if the maths
so that's a depreciation of 6.32% per year, every year for 50 years.
Correct, 100%.
Okay.
And unfortunately, if you're in Malawi, you sort of 25% devaluation. We do lots of business in Nigeria. There's been a devaluation of 11%. But then if you just have a look at the column on the right, taking the average decline in the local currencies to the US dollar, and now we extrapolate that a further 30 years. That same South African rand in 1992 that bought me $1 for R2.89, it's going to potentially cost 114 Rand in 2052. So what are we talking about? We're talking about currency instability in Africa compared to obviously currency stability in primary economies such as the US, as I've used the US dollar here, but more importantly, the British pound.
Okay.
The second, if we go to the next slide, Fred, the second's obviously quite apparent as the economic instability in Africa compared to the reasonably economic stability in the UK. And yes, we would argue there's been some ups and downs, and ever since Brexit, and there's gas problems in the UK, and there's housing problems in the UK, and yeah, absolutely, but we've all got these problems. The one thing that the UK doesn't have is load shedding, and as you and I know, Fred, we experience 4 to 6 hours of load shedding a day, which is causing major economic instability. Just last night, the South African budget was announced, and the South African government is applying 254 billion Rand towards Eskom. That's going to put the economy under a lot of pressure. And then lastly, unfortunately, there's an incredible amount of political instability in Africa compared to a degree of stability in the UK. So the question is Lagos a great opportunity to buy property? Yes, I think it is, but it's a growth asset. Today, what we're talking about is preserving your wealth. So we feel as though UK, London, Manchester, Birmingham, these are the places where we need to start targeting for wealth preservation.
You remind me of having a conversation with a guy in Lusaka specifically, and he's a big property guy in Lusaka, and we're talking about the pros and cons of London versus Lusaka, or in general, and it came to me to perhaps give him a little bit of a practical test, if you'd like, as to how strong his conviction truly is, because it's hard to get a proud man to acknowledge that there might be something better out there than what he's already invested 20 years of his life in. And I created the reality for where I asked, listen, John, we're sitting here with your property portfolio in Lusaka. We can well imagine that there's another John sitting in London with his 20 properties. And if I can ask you the question as follows, John Lusaka, would you swap places with John in London? To which his answer was, yeah, that would be a good swap. And then, of course, the crux of the matter, and what do you think? Would John London swap his 20 UK properties for your 10 or 20 Lusaka properties? To which the guy almost spat in his coffee and said, I see your point. So yeah, absolutely. When it comes to long-term stability, I think UK plays a huge role in adding that to us. But we're talking about using property as a specific asset allocation in our clients' portfolios. which means we've got an opportunities cost problem. Because if we're putting the money into property, it could have gone into equities. It could have gone into a balanced unit fund portfolio. It could have gone into any number of alternative options. Where does property fall when it comes to its specific growth orientation compared to other asset classes?
I think it's very, very simple, Fred. You know, UK property, it's not a boring asset class. But if we have a look at what I call the jelly bean graph, yeah, that's it, Fred. You're getting me confused now. The jelly bean graph. Now, a very, very busy graph. So very, very quickly, we've taken, you know, all the asset classes. We've had a look at the last 50 years in terms of how these asset classes performed. We will all know that equities in 2022 on average fell by 25%, which is a disastrous number, but there's obviously reasons for that. But if we have a look at the stats labeled 1 through to 5 at the top of the slide, only 6 times in the last 50 years has UK property, okay, been the worst performing asset class. 2 in the last 25 years. 19 of the last 25 years, 19 of the last 25 years, that's 80%. It's beat inflation. 43 out of 50 years, it's had a positive growth, and year on year, it's averaged a return of 5.5% in the last 10 years. So Fred, if we take the number of 5.5%, yeah, 5.5% in hard currency, a lot of people will take that, especially where interest rates were possibly 6 months to a year ago. We'd even probably take it now. But if you do us a favor and just go back to that sort of currency devaluation chart, and if we take that number of 5.5%, and let's take Nigeria for argument's sake. Nigeria's currency devalues at 11.58%. If we add 5.5 on top of that, we're now talking about 16-17% return for that same Nigerian naira that's devaluing by 11% a year. So again, we're going back to what are we looking for? We're looking for a wealth preservation tool that protects us from currency instability, political instability, as well as economic instability. And as you said at the beginning, I've been in this business now close for 25 years. I've never seen a better wealth preservation tool than UK property in the past, but more even important going forward. We're going to see a lot of positive movements in the UK property market. George, what are your thoughts on this? You know, do you feel the same?
100%. I was just looking at your slide, Fred, London or Lagos, which is obviously quite topical, given you're talking about currency depreciation, which I know is at the forefront of all of our Nigerian clients' minds at the moment. And then you've got your political and economic instability. With the elections this weekend, you know, probably only going to get worse, sadly, in the short term. So I hope they go as well as can be expected. But the fact of the matter is, we always, as you know, I've worked in property for over 20 years and chartered surveyor by trade, and having spent the last 13 years working with clients based in Africa, investing in the UK market predominantly, we always get asked the question, why shouldn't I buy my flats in Johannesburg? Why shouldn't I put my money in Lusaka? Why shouldn't I, you know, buy this place on Victoria Island in Lagos, wherever it may be, because I'm getting double-digit yields, but you're also getting double-digit currency depreciation. You're getting double-digit financing costs if you've got access to any mortgages. And the other one I often get is, why shouldn't I invest my money back into my business? You know, I can double my money in a year. And to the point that both of you made, Africa and African clients, I've got a lot of admiration for them because they're so entrepreneurial in terms of making money. But what we're talking about here is preserving money, isn't it? And diversification is absolutely key. And as you said, Craig, you know, not talking about externalizing all of your funds. You need to be making money locally to sustain your lifestyle, send your kids to school, and, you know, live your life. But in terms of preserving your wealth, externalizing some of those funds and investing it in, a very safe and sound UK property market makes absolute sense. And we know on your jelly bean graph, Fred, as you call it, quite simply, if you buy well in the UK, and I think buying well is absolutely key as well. Anyone can go and buy a property. You've got to buy a good property in the right location with the right developer. But if you do that and you buy well in the right place in the United Kingdom, we know that history shows us every 10 to 15 years, the value of that property will double. So not only are you getting that, very safe and sound and secure capital appreciation and strong rental growth, but you're also not losing 50, 100% every decade on your currency. That chart actually on the currency depreciation makes you quite sad, especially when you look at like the rand, two rand to the dollar. I shouldn't laugh, back in '92. You can see why it's such a concern for everyone to sort of diversify.
As it needs to be, George. As it needs to be, I think humans are a bit naughty, and our clients are a bit naughty when it comes to understanding the effect of compound interest over a long enough period. And I'm not saying a long enough period for 100 or 150 years. I'm talking about 30 years of retirement. In 30 years of retirement, African inflation and African currency depreciation is the leading cause as to why our aged population don't have financial independence across Africa. Categorically, it's not bad investment, it's not bad advice. It is quite literally inflation and currency depreciation. Biggest wolf at the door. So look, we're painting a very, very positive picture about property, specifically UK picture. I think Craig, you've waxed lyrical quite correctly about the sustainability on the role it can play in the preservation structure. But George, by the way, all the listeners, thank you very much for all the questions you sent through from all over the continent. Some of them have been really, really interesting, and some of them have been quite predictably, and please understand what I'm saying here, mundane, in that we get given these questions on a very, very regular basis, because lack of knowledge is exactly that, a serious lack of knowledge. And hopefully you walk away today with a hugely better perception of what can or can't be done. So let's deal with some of those basics, George, as to if property in the UK was such a beautiful story, and it is, why don't more Africans across the continent currently buy property in the UK?
I think primarily they don't know how to do it. Also, they're concerned, rightly so, because it's a trust issue. It's a big move. It's one of the biggest investments you'll make, and it's offshore. And if you don't know how to do it and you don't understand it, that creates fear, doesn't it? Really, and you get concerned, which I would urge everyone to do, because you've got to make sure you're working with the right partners. Secondly, I think affordability. I speak to a lot of clients, and it's like a light bulb moment when you're having a meeting that they realise they can afford it, because it's very much the perception, isn't it? And the media have a large part to play in this, that only oligarchs and billionaires can buy London real estate or UK real estate, and we know that's very much not the case. So yeah, I think it's those two factors primarily: lack of understanding about how to go about it and how to do it effectively, safely and securely, and the lack of understanding, in all due respect, that one can afford it. As you know, Fred, our focus is wealth preservation, but also wealth growth, and working with your white collar professionals, middle class, for want of a better expression, people out there who are trying to preserve their wealth, grow their wealth for their children, and that's very much what we're focusing on. We're not focusing on multi-million, £5-10 million prime London properties. We're focusing on very digestible UK buy-to-let properties in the right locations where people can get access to for, let's call it £100,000 of total equity. And we'll come on to some cash flows a bit later in the presentation.
And we are. So let's deal, George, if I can interrupt you, let's deal with, and I know that you can give us long answers on each of these, but I'm going to ask you to try and keep this down to one sentence answers only. And the answer is not allowed to be RPA does it for you. In other words, my company does it for you, which in general, I know you do. Yeah. So let's go through these questions, because this has really been a summary of a lot of the questions that have been sent through to us. So the first question then, I'm a Lagos, I'm a Lusaka, I'm a Lilongwe, I'm a Harare resident. Yeah. How on earth do I know where to start in defining what is a good property and what is a bad property in the UK?
Location, location, location. So that's,
okay. And that's we definitely, I know we're going into that in a few moments in a slide with you specific. So looking at location. Okay, how would I get a mortgage? And can I get a mortgage as an African citizen and resident for a foreign country?
yes, you can, and we can assist you with that. So you can definitely get a mortgage. We do it every day for our clients, and Carrick and RPA can assist you with that process.
I'm going to deal with the bottom two questions in the same question because they're typical landlord questions. You know, when the geyser goes, when the boiler goes on a Sunday morning, and I get the phone call from the tenant, then at least in Blantyre, I know who to call to go and get it sorted. I get that phone call from a London tenant or a Birmingham tenant. How do I deal with that from Africa? And the second one is, how do I ensure that the tenants I'm putting in my property are trustworthy and above board?
Okay, so collectively, Carrick International Property and RPA, so we provide a turnkey solution, an end-to-end solution, which covers all of these points, and one of which is obviously the securing of the tenant. So we will manage that process for you. We'll manage the property handover. We'll do the screening of the tenants, the tenant referencing. We'll do the legal agreements. We'll collect the rent, pay it into your bank account. Any issues with the property, which there shouldn't be, because we're looking at new build properties, we will manage that for you. So you don't need to worry about it.
And then the nitty gritty, I love when this question comes up because you definitely know a client who's seeing himself, he's seeing the post, I'm now the landlord, and he's seeing the problems past that, going, well, listen, how do I get some furniture in there to make it a lettable property?
We'll do that. So we'll provide the furnishing packages for clients. Not always necessary, so don't want to waste costs, but we will do that for clients.
Stunning. Thank you. And I know we're dealing with a few of these as we go on. Yes, Craig?
Sorry, I think what's also very important to point out here, because it takes up a large portion of both myself and my compliance team's time, and I know it does George. So once you've got your head around all these things, can I find a solicitor? Can I this? Can I that? One of the biggest risks facing any investor into any property or any investment is the due diligence that you do on the actual investment itself. Yeah. And as George says, location, 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 number one. Number two, the actual financials of the developer. And that's why I encourage every single individual, not just property, but any investment. It's one of our mantras, Fred, as you know, we've been talking about this ever since we started Carrick. Do your own due diligence. Make sure, the right due diligence. And that's why people employ services from Carrick and RPA, because we do that. And it's a very tedious task, but we tick all the boxes. We've got a property investment committee that goes through financials, financing, lease, the whole lot. So we know that when we bring a property to market, sufficient DD has been done, and we do that obviously in conjunction with George and his compliance team, who are actually based in the UK as well.
100%. I mean, that's where fundamentally, sorry, Fred, these investments come up, is the lack of due diligence. What's the financial standing of the developer? Have they got planning? Is it conditional? What's their funding? So on and so forth. And we've seen, bad things happen in the past, not ourselves, but other parties. And just to reiterate from your side what you said, Craig, do your own due diligence. There's so much information out there. Get online and do your due diligence and get comfortable with the investment you're making. But just to add, you've got on there, Fred, how would I find good solicitor? We work with national UK law firms. They act on behalf of the client. So it's not just what we are telling people that we've done. The solicitors act on behalf of the clients, the buyers. They represent the buyer, not ourselves. And they will do all of the due diligence above and beyond what we've done to make sure that anything the client's going to is safe and secure.
And when all is done, you also make yourself available, if I'm not mistaken, because we were chatting quickly before this, aren't you getting onto a train after this call for 2 hours to go and meet prospective Nigerian investors at the actual development later on this afternoon?
Yes, I am tomorrow morning, but yeah, I'm going up to Birmingham. Yeah.
Well, there we go. Fantastic. Right. Okay. So let's start talking location. Greg, breaking down the UK into its larger parts, if you'd like. Where, or perhaps give us a brief oversight into what the UK looks like in the various sections. Apologies, we had a little glitch there. In its various sections, and why we are looking more at the north, if you'd like.
Again, Fred, you know, London-based properties have always been a trophy-based asset. They're inherently a lot more expensive. You know, you're talking about, you know, 1 million plus for a two-bedroom apartment in the right particular area of London. And London has been consistent in that it's performed at 3-4%. But again, if you have a look on the graph on the left, if we look at, you know, from Birmingham north, we're just starting to see some fantastic capital yields coming out of the northern part of the UK, such as areas as you know, Liverpool, Manchester. One of my favorites is Birmingham. A lot of great stories, which I know George is going to talk about, is Birmingham. And then, you know, you're just talking about, again, your currency devaluation. If you're leveraging your asset, you're using potentially cheap money, and you're getting a 5.5%, 6%, 7% capital appreciation, as George says, over a 10 to 15 year period, you're doubling your asset, or you're doubling your value of your asset. Then you've got your rental yield, and coupled with the currency devaluation. That, in my mind, is just a fantastic story for wealth preservation. In terms of the hotspots, as I said, Glasgow, Liverpool, Nottingham, Manchester, Birmingham are my personal favorites, and those particular areas have been backed up with a lot of statistics from very well-known companies in the UK, and those particular locations are also backed up with great rental yields as well. So for me, my money's going into the northern part of England opposed to the south, just because, as George mentioned, location. There's a lot of things happening. There's a lot of housing shortage happening in these particular areas, so it makes for a solid, sound investment.
And that's a great place to hand over to George. George, you take us into a bit of insight. You've mentioned location. Also the name of one of my grandmother-in-law's favorite TV programs, by the way. Whenever I walk into the home and she's visiting, I hear them talking on the TV. But RPA, as your rep, if you'd like, as your representative in the UK, you've mentioned earlier the amount of work you put into it. I know that the next few slides we're going to be dealing with two things really. One is you're going to be impressing on the listeners the amount of detail that you guys go into, not only due diligence of the project itself, but the city as a whole, and then even subsectors of a city, which is fantastic. And then we have mentioned Birmingham a few times. We're going to use that as an example, if you'd like. So, George, if you can take us through then the story that sits behind Birmingham specifically, and what you believe, the amount of research that you guys have done, and the types of returns that you're expecting in the general area.
Sure, brilliant. Thanks, Fred. So, if I put myself in the place of the audience, you know, in Africa, and there's so much information out there. When you go online and you type in UK property investments, and there's weird and wonderful places that come out, and that fundamentally, when you're buying property anywhere in the world, you need to buy in the right place, and that's why I say location is key. And that's we're not just talking about the right city, we're talking about the right country. And the UK right now represents a very good environment for property investment, you know, for all the reasons we've mentioned. But then if we look at the UK economy and the key growth areas, for me, London is great and will always have a place in clients' portfolios. But as Craig mentioned, you do get, you know, it comes at the price tag, the yields are less, the operating costs are much higher, which impacts your overall return. So for anyone who can afford having London in their portfolio alongside of Birmingham and something else, great. But a lot of people are not in that boat. So if we're then going to, you know, where can I invest 100, 150, 200,000 pounds maybe, and really optimize my return on investment, in my view, there's no better place in the UK right now than Birmingham. It's the number 2 city in the UK, so it's the second largest city in the United Kingdom outside of London. Population of over 1 million. It's a booming population as well. It's growing. It's very, very young population, one of the youngest in Europe. And it's got the highest concentration of international companies in the UK outside of London. So what we've kind of got here, and we'll come on to infrastructure in a minute, but we've got the perfect storm in terms of all the ingredients that you need for a very safe and sound property market, because you've got a scarcity of supply. We can see there, you're almost 80,000 unit shortfall in terms of properties coming online for local buyers over the next sort of 10 to 15 years. But you've got a huge demand and you've got a growing population. And simple laws of economics, we know that drives up property prices, and we know that drives up rental values. So can you go to the next slide, please? Please, Red.
Absolutely.
So, excuse me, infrastructure is so key. We saw in London the Crossrail or the Elizabeth line. Anyone who's been lucky enough to go on it's brilliant. 100-kilometre railway line all the way across central London. And this really is the next phase in the UK sort of drive to enhance its train connectivity. So the HS2, for those who are not so familiar with it, is the new train line initially from London to Birmingham. It's under construction and it will complete in the next 10 years. So by early 2030, instead of it taking an hour and a half, which is roughly what it takes now to go from London Euston to Birmingham, it'll take you 45 minutes. So why is that important? It's so important because Birmingham now becomes effectively a commuter town, a commuter city of London. You can live in Birmingham and you can work in London. But also from a commerce perspective, you think about big companies, it's so much cheaper to employ staff in Birmingham and for staff to live in Birmingham and have offices in Birmingham than it is in London. So suddenly that's why you can see so many of these international companies are relocating their headquarters in Birmingham, because it just makes sense from a business operational perspective. And as a result of this improved infrastructure, it's also driving the growth of Birmingham Airport, which is expected to double, excuse me, pretty much over the next 10 to 15 years. Over £500 million of redevelopment going in there. And in very simple terms, why is the airport expanding? Because it's easier to get to. So, so the HS2 for me is a really key catalyst in the future growth for Birmingham. And I really believe now is a great time to be buying into Birmingham, because you've got a nice run in, 10, 12 years, let's say, until those works are completed. A lot of people don't realise also that Birmingham is the headquarters for HS2. So it's creating almost 40,000 jobs. And also, if you look at a map geographically where Birmingham is located in the UK, it's bang in the middle. So everything that comes off HS2 when it goes to Manchester, it's not going to Leeds anymore. Birmingham is the interchange. It's the central point of all of this. And above and beyond all those points, great things I mentioned about why Birmingham's growing and the universities and over 100,000 students and all the Michelin star restaurants and everything else, that for me is really, really key in why Birmingham makes more sense than pretty much any other UK city right now for investment. Fred, can you go to the next slide, please? Is there any questions that you want to stop me? And
no, not at all. You carry on.
No, okay. And just to clarify, we've got opportunities, widespread across the UK. But I'm particularly passionate about Birmingham. So I don't think my mouse is working. Yes, it is. Okay. So this is Birmingham city centre here. All right. And this is our new development, which we'll talk about in a bit more detail now, this Tyndall Court. And this whole area across here is the Jewellery Quarter. So for those of you who are not so familiar with Birmingham, as I mentioned, that's the city centre. The Jewellery Quarter is the bang next to the city centre, from where we are 5-7 minute walk. But it's the old industrial area where they used to manufacture significant amounts of jewellery. It still accounts for 40% of the UK jewellery production. But what's happened over the last few decades is systematically a lot of these beautiful old heritage buildings have been redeveloped to residential. So now the Jewellery Court has become a prime residential area right in the centre of Birmingham. And what we also like about the Jewellery Quarter, Fred, is the fact that if you look at Manchester, for example, great market, but Birmingham's probably 5 years behind Manchester in terms of growth. And if you go into Manchester city centre now, there's a lot of high rise. There's a high supply. Okay. Whereas in Birmingham, in the Jewellery Quarter, you can't build above 4 stories. So it really constrains that supply, which is great. And 40% of the people who live in the Jewellery Quarter will walk to work. So suddenly you've got a prime residential area that represents great value on the doorstep of the city centre and the second largest city in the United Kingdom. Coming back to your point, Craig, 2-bed in central London, let's say London Bridge, because that's effectively a 5-minute walk across the city of London. Easily £2 million plus, £1 million plus for 2 bed. Probably 2 million, depending on how luxury you want to go. Here, you're a 5-7 minute walk to the Birmingham city centre. A 2-bed, £300,000. So you've got to look at the relative value, and we're here talking about investment, upside on capital appreciation, rental growth, and so on and so forth. And that's why I really like Birmingham. Sorry, just before we go on to the next slide, Fred, this, as you know, is Scholars Quarter.
Yeah, apologies.
That was the most recent project we did. Sorry.
Yeah, we're going to get there.
Right there, now under construction. This bit where the crane is, you probably can't see that. That was the copper works, which we'll come on to in a minute. That was phase 1 of this master plan of the Jewellery Quarter, which is completed now. This little site here was New School House. That was phase 2. This part here was Scholars Quarter, which you know very well, phase 3. Yeah. And where this cursor is Tyndall Court, and that's phase 4 of the redevelopment of this part of Birmingham. So we've been heavily involved for the last 3 to 4 years in this site. Can you go to the next slide, please?
So let's do that then. Let's talk Tyndall Court specifically, because that's a very good example for all our listeners as to what an actual direct property ownership looks like, because we've really been conceptual. We've spoken about the geography of the city. So let's go into the nitty-gritty of what the actual property and the costings would look like, if you don't mind. So we're looking at Tyndall Court and Jewellery Quarter. Talk us through it, please, George.
Okay, yeah. So it's a new build development. We're working with King's Crescent Homes. As I mentioned, we've worked with King's Crescent Homes over those previous 3 phases. So this is the 4th phase of this master plan. Why is that important? They're a great developer, firstly, but it shows that we're delivering products, which shows we're delivering great products in the right locations. And we've got a very strong track record to back up what we're talking about here. So this is the 4th phase, 53 apartments, a mixture of 1 and 2 bed units, spread over 4 levels. So you've got ground floor and then 3 upper floors, depending on which part of the building you're in. 1 beds starting at £220,000, and the 2 beds from £295,000. All right. It's off plan. We're looking at a 2-year build period. We've just broken ground. I'll share some photographs with you both after this, actually, and obviously tomorrow once I've been to Birmingham. But we're looking at a 2-year build plan, which means that from today we're looking to complete at the end of 2024. And in terms of, we'll come on to the payment terms in a minute, but in terms of the rentability and what we're looking at from a yield perspective in this development, on a long-term rental basis, so that is your traditional 1-year, 2-year tenancy, what we call an AST and a short hold tenancy in the UK. We're looking yields up to 5.7%, but we do have the ability here, Fred and Craig, to do short-term lets because there's no restriction in the ground lease. Short-term lets are often promoted and talked about when in reality they're not possible. But because the ground lease is unrestricted here, we can do short-term lets, and that's Airbnb, Booking.com, and so on and so forth. And that can really drive up your short-term rental yields up to sort of 12%. So in a slightly higher interest rate environment, obviously that can be very compelling for some of our clients. Sure. In terms of the payment terms here, let's say sitting down with a client, we want to go ahead, reserve a unit. £2,000 reservation fee that secures the unit. Then they would be looking to make the 20% deposit payment within 4 weeks on the exchange of the contract. That's when you legally have the right now to buy that property, and the developer's got the legal obligation to deliver that product for you. And then you don't do anything for another 2 years, and at the end of 2024, that's when you would settle the balance of 80%. Obviously, a large portion of that will be covered by, let's call it a 60% mortgage. Should we go to the next slide then, Fred?
Absolutely. So, sorry, the lameness is quite. So there's some visuals. Obviously, is that Tyndall Court itself, George?
This is the internal courtyard of Tyndall Court. This bit at the end, you can't quite see it. That's actually Sloane House at the end there. That's built, completed.
Okay.
And this is Tyndall Court, the internal courtyard area. There's a listed building right at the front there, which I think is on the next image when we go to it. And then this is it's a U-shaped development. So that's the internal court. Yeah. So you, as I mentioned, it's ground and 3 upper floors, depending on which part of the development you're in. Right. So let's have a quick look at just a very simplified cash flow. So this is a 1-bed unit, C108. It's 525 square feet. It's on the first floor. It's one of the larger 1-beds, so that's about 45 square meters. And we're looking at a purchase price of £250,000. Okay. So in terms of the initial payments, it's a £2,000 reservation fee today to secure the unit. Clients would then be looking over the next 4 weeks to pay a 20% deposit. So let's call it £50,000. And then that's it. You're in, let's call it £53,000 over the next 4 weeks. You don't do anything for another 1 3/4 years, 2 years. And only when the property completes would you then be looking to make the final payment, which would be £58,220. So that's based on a 60% mortgage, just to clarify. Which gives you a total cash requirement for a 1-bed in this development of £110,000, £111,000.
Okay.
But spread out, obviously, initial payments and then the balance in a 1 3/4 years, 2 years from now. So what does that actually mean then? The property's completed, you've taken ownership, your mortgage is in place. If we're looking at a long-term rental basis, your net return, what you're receiving in your bank account, you know, at the end of all your costs after everything, £2,400 a year. Okay.
So it breaks even. It's a positive investment from day one. Your rental income covers all your mortgage expense, and you walk away with, even in year 1, with a chop of change of a nice £2,500 Christmas bonus.
That's correct. Yeah.
Okay.
And then we're just looking at 5-year return. So this is return on equity. So this is return on £110,000 invested, which is really important. A lot of people look at what you're getting back on the purchase price. You know? But we've got to be looking at how much money am I putting in, £110,000, and how much am I going to be getting back on my investment. And the culmination of the rental income and the capital appreciation will give you a 5-year return of 58%, say, and a 10-year return of 132%. So pretty decent. But then if we're looking at the short-term rentals, obviously your net rental return per year is higher because we're sweating the asset more. You're looking at £6,840, say, net after all costs each year. And that obviously is a result of the increased rental income. It does drive up your 5 and your 10-year returns up to sort of the 180% over a 10-year hold. So I think the message here, Fred, is it's off plan. The payment terms are favourable because you only outlay your 20% now to secure an investment that completes in 2 years. So you've started the process, you've secured an asset in the UK, and you can manage your cash flow accordingly. We will secure your mortgage for you to help you finance the investment. And when that property completes, we will manage the property for you. And every year you'll get X amount in your bank account, and over a 5 to 10-year hold in GBP, you'll get a very, very strong return on investment.
George, I've quickly had a question come in from a listener actually sitting up in Nigeria, of all places, because obviously it's going to be Nigeria. And the quick question is, do I get the rental paid to me, or is there some in-between account? Does it go through you, etc.?
So it will be our lettings and management company. So they will manage the property for you. Obviously, these are predominantly for our international clients. They want it to be hands-off.
Yes.
We manage the day-to-day running of the property. You know, it's all, you know, the UK is one of the most regulated, if not the most regulated property markets in the world. So it has to be compliant. The rental agreements have to be compliant. It needs to be managed in the right way. And therefore, you really need to use a local lettings and management company. They will take the rental income from the tenant. They will pay any of the operating costs, such as the service charge, say, and then they will pay the net amount into your designated bank account on a monthly basis.
Okay, perfect. Thank you. But that's obviously the current offering that you have at the moment that most closely fits the story that Craig and I have been talking about. That's really how we use a unique property like this in a long-term wealth preservation strategy. But this is obviously not your first time at the rodeo. George, you've done this for many, many years. Talk us through briefly then 2 recent projects that have come to an end over the last, I don't know, 2-3 years, I reckon.
Yeah, perfect. Next slide, please. So, I mean, you'll both be very familiar with these, I'm pleased to say.
Yeah.
So the Copperworks, this is phase 1 of the development we were just talking about, the master plan. So this completed last year. It's now fully tenanted. It's with King's Crescent Homes again, obviously. Pleased to say that the rentals we got on here, the 1 beds came in about £100 more per month than we forecasted, and the 2 beds about £150, £200 more a month than what we initially forecasted. So, you know, what I'm saying is we're conservative in our assumptions, and as you can see from the images there, we deliver a top quality product, and we work with the best developers in market. So that was a hugely successful product, and really excited that for all our clients that bought in there, and a number of Carrick clients, obviously. This is with King's Crescent Homes again. This was our 2nd development with King's Crescent Homes in Ashford in Kent. It's under construction. You can see there the exterior is all done. We're now doing the internals, and this is the show apartment, which is now ready. So anyone's in England wants to come and have a look, please do. It looks great, and this is due to complete June, July, Block B, and then Block D will be more like sort of September, October. So well under the way, and looking forward to seeing that come together as well. And those are just 2 examples, Fred, of hundreds of projects that we've been involved with over the last 20 years. So yeah, hopefully it adds a bit more colour for our listeners and adds a bit more credibility as well.
Well, I'll venture and I'll dare to say that a number of our clients are actually on this webinar as well, because what we do find is that people who over the last 4 or 5 years have bought their first international property quite often return, and we have a huge amount of retake up. So people come and buy their 2nd and 3rds. So yeah, we have listeners on this call at the moment who directly own property in both these projects. So that's, to me, a wonderful thing to mention. Gentlemen, I want to thank you very much for going through the official presentation there. I think we've covered a huge amount of information. I've been scanning through the questions that have been coming through, and I think some of these we have answered, but if you'd like to just bear with me for a few moments as we make sure we do. There's been a definite theme, George, coming from a taxation side of things. So if I buy property in the UK, what is the default tax position? If you could perhaps take a few moments to answer that.
Yeah, so I mean, typically 2 ways of buying recommended in your personal name, which is very common, or a UK registered company. Obviously, some people would still want to buy in an offshore trust. Costs are pretty punitive, to be honest. So either a personal name or a UK registered limited company would be the 2 recommended. And then it's your usual stuff, your income tax, your capital gains tax, and your inheritance tax. So income tax, you're buying one investment in the UK, it's not really going to impact you. By the time you've offset all your operating costs, your net rental income, you're not unlikely to go above that sort of tax threshold of £12,500, say. What do I mean by that tax threshold? That is your tax-free allowance. And international clients, provided they're based in a country with a DTA, a double taxation agreement with the United Kingdom, will still benefit from that. South Africa, for example, Nigeria. The second one is capital gains tax. We can't escape that, you know. It's a good problem to have. It means we've made money in sterling. And, you know, that's on the sale of the asset. You'll pay capital gains tax. Everyone gets an allowance. Again, £12,300 is your tax-free allowance. And thereafter, any profit, net profit, so you deduct all of your transactional costs, legal fees, agency fees, redevelopment fees, whatever it may be, get your net amount. And then any net amount above that 12,300, you pay 18%. And then once you get into the higher tax bracket, you'll pay 28%. So you're probably looking at a blend of CGT around 20% buying in your own name. CGT, when buying in a company structure, is corporation tax. So depending on the size of the company, 19, 20, maybe 25%, depending on your company. And then inheritance tax is one we can't escape. But again, you're buying 1 or 2 properties in the UK. You're managing the purchase with a mortgage, which most clients would do. You're never going to go over that inheritance tax threshold, and therefore you won't have a UK inheritance tax liability. But it is important to get a will, a UK will.
Okay, fantastic, Craig. There are a whole bunch of questions of how does me as a Zambian, I can see a Zambian, there's a Kenyan who asked the same question, we've got a Ugandan who I love it when Ugandan dials in, asking all the same questions. I think you have really answered this already, but perhaps just a few reminders then. Maybe they dialed in late because the question's only coming through now. How does owning international property benefit me as I said, Zambian, Nigerian, Ugandan?
100%, Fred. And just before I answer that question, let me just touch very briefly in terms of what George has said. We're moving into a new era, and structuring offshore investments to mitigate tax are becoming a thing of the past. We're seeing it more and more. Countries that have been regarded as tax-free safe havens are now rolling out a 15% flat tax rate. So this is the world that we're living in. So therefore, again, what we need to do is how do we create a wealth preservation mechanism, i.e. that preserving my wealth, making sure I don't lose my wealth, is far, far more important than growth. UK property does that. Secondly, and again, I don't think George really reiterated, I've known George for 15 years now, and he's a very, very humble man. King's Crescent Home, Jewellery Quarter, what they've basically done, we're talking about, this is the 4th development. All 3 have been a phenomenal success. Fully completed, fully tenanted, the first 2, the last one being done now Tyndall Court starting. So we spoke about safety and security of your investment. What is your development risk? King's Crescent Home have been building for 28 years in the UK, and they've got a track record of 3 builds next to each other, right adjacent to Tyndall Court. So it's a phenomenal opportunity, one that we really like. So it's all about wealth preservation and utilizing your African currency in a far, far more beneficial way for future generations.
I've scanned through the rest of the questions, some really interesting questions. There's a question from Namibia, which I think is the first one I've seen across the 3 webinars we've done this year so far, and that is, if I have $150,000, is that enough to make an investment? I think we've answered that very well, George. Thank you very much. And in all fairness, the rest of the theme questions, perhaps a bit earlier in the presentation, before you dealt with whether or not non-citizens can buy, I think we've answered that very clearly. George, in the name of time, because I think our listeners have very kindly given us a full hour and it's now slightly over. I'm going to put you on the spot because it is a big question out there always when clients come to put the money on the table. Hey, is now, given the macroeconomics of the greater Europe, is now a good time to buy property in Birmingham?
100%. I suppose another way of answering your question is, what else are you going to invest in that's going to give you a better return?
Well, I guess there's some betters, but not the more sustainable when it comes to. So yeah, I think that's very true. And then, Craig, I'd like to give you the final word here, if you don't mind. Given property, given the global pressures on wealth preservation, I know you've touched on this numerous times today, but perhaps just bring it to a close today. What are your final thoughts when it comes to property as a key investment strategy?
Yes, thanks, Fred. So from a conclusion perspective, I think that there's 3 points, and I've harped on about all three rather aggressively. Although wealth preservation and growth is not often considered to be a sexy property investment strategy, that doesn't make it boring or exclusively for the high net worth individuals. As the listener in Namibia has just pointed out, for $150 US, 150,000 US dollars, I can get into this great story. Number two, in an uncertain market, equity markets were down 25% last year. In an uncertain market, a slow and steady strategy wins the race. And a focus on wealth preservation is actually a very, very much worthy investment objective. And finally, Fred, focusing on longer term wealth preservation and growth can help investors avoid the common and the most expensive mistakes. And those most expensive mistakes usually mean investors lose money. So rather think about long-term wealth preservation opposed to quick get-rich-quick schemes, which there are many out there, which unfortunately a lot of them result in unnecessary losses. So those would be the three things that I would focus on.
Craig and George, I want to thank you both sincerely for spending time with us. I know you guys are incredibly busy. When I reached out to you guys a few weeks ago and told you that we were going to do this webinar, neither of you hesitated in saying yes. And thank you for that. And sharing with us today, both your knowledge and your experience in what hopefully has been a rather informative webinar for our listeners all across Africa. And those are the last people I'd like to thank. Thank you very much for dialing in. I know you're all probably hiding away from your computer, away from somebody at work at the moment as you're sneakily listening to us, and that's absolutely fantastic. The contact details are on screen, specifically the webinars at carrickfs.com email address. So that couldn't be more difficult, but if you want to take your phone right now and quickly take a photo, we're going to leave it on the screen for another 10 seconds or so. So please, we've got a number of ladies and gentlemen who actually cover that email address, making very certain that any question you have will be referred either to your advisor, to George himself, and then Craig's asked me to man up on that side of things, so I'll do that as well. So guys, thank you very, very much for dialing in again. I look forward to seeing you guys at the next webinar, and that will be advertised over the next week or so in a month's time. Craig, George, thank you again, and goodbye.
Thank you.